So now our first presentation this morning, an industry update from the Insurance Information Institute. Dr. Stephen Weisbart is the Senior Vice President and Chief Economist who oversees the Institute's Economic Research and Analysis Program. His specialties are annuities, pensions and life, disability, and long-term care insurance. Don't worry, he's going to talk about property and casualty, don't worry. So, joining us here today from New York to talk about the state of the economy and its effect on the property and casualty industry, please welcome Dr. Stephen Weisbart.
Thank you, Frank. Good morning, everyone. It's a pleasure to be here. I grew up as the son of an independent agent, literally. My dad was very committed to the Big I. He was president of the New Jersey Big I and then became state national director for 10 years. So this is a bit of a homecoming for me in some ways. I'm very pleased to talk with you. I do have a question about scheduling an economist this early in the day. I don't know how many of you signed up in college to take economics at 9 o'clock in the morning. I doubt that it was a whole bunch of them. I didn't either, so we'll do the best we can to keep you awake. But we've got a bunch of good stuff to get through. I'll go pretty quickly through it. If you see any slides you want to see again or want the whole slide file, I'd be happy to provide that. Just send me an email, stephenw@iii.org. It's the practice and policy of the III to make these slides available to anybody who wants to see them or reuse them in any way. We'd be really pleased and flattered if you think there's some beneficial use beyond my presentation this morning. So let's get started. Let's see if we're not getting my presentation up. So this will take a long time. While we put the slides up. I can't talk without a PowerPoint. I'm sorry about this. I can't even have a dinner table conversation with my wife without the PowerPoint slides. So now that we have them, we can get going. My first point is that a lot depends in terms of the growth of the PC industry on the growth of the U.S. economy and the local economy. This chart, the blue line, shows you the net written premiums for property casualty over the years since 2000. The red line is the nation's gross domestic product. Again, since 2000, year by year, I boxed off the 2 years of the Great Recession, so-called. And you can see that because of the hard market that we had in the first part of that decade, premiums increased faster than the economy did in general. But the slowdown began around 2005. By the time the recession was over, they were pretty much together. And since then, the net written premiums have grown at about the same rate as the U.S. economy has. And so one can say that if that trend continues, focusing on what the economy is likely to do gives us a clue as to what the increase in net written premiums is likely to be at least in the near-term future. So let's look at what we think is in the forecast. This chart comes from a survey of 53 econometric forecasts that are published every month. The green line at the top is the average of the 10 most optimistic forecasts. The red line at the bottom is the average of the 10 most pessimistic forecasts. And the orange line in the middle is the midpoint of all 53. Couple of points. Number one, every single forecaster sees things getting better. This is quarterly data from the fourth quarter of this year through the fourth quarter of next year. All three lines move up. So that means that absent some really weird and strange things going on in Washington, well, I guess maybe we shouldn't assume absence, the economy will improve, continue to improve, and the only question really is how much. The second point in looking at this is tremendously broad variation among econometric forecasts. Even the pessimists think that we will do at least after this quarter 2% growth or better, but the optimists think it will be almost twice that. Tremendous amount of variation. Nobody really has a good clue. We really don't understand under these conditions what is likely to drive the economy with any confidence. In terms of vulnerability to the Sequester back from last March, the continued sequester until we have any alternate plan for funding the federal government. This chart colors in the states according to the impact of federal spending on state GDP. I've circled South Carolina because after a few other states, Virginia, New Mexico, and Kentucky, it's one of the highest, most affected states in the country in terms of federal spending. So as long as this continues and gets worse, the impact on South Carolina may be worse than it would be on many other states around the country. This map comes from the Federal Reserve Bank of Philadelphia. What they do is they take the numbers that contribute to the package of leading economic indicators, and they apply them to each state each month. Now, this is based on an assumption that these factors will influence the economy in those states for the next 6 months. South Carolina, again, circled. In this case, the pink coloring means that the economy in this state is likely to be weaker than that of many other states. The dark green are the stronger growing states. The only red state, which is the weaker even level than South Carolina, is Michigan. So it looks like this is not a bright period of time in the next 6 months or so for South Carolina, but these things can change fairly quickly. So particularly if the sequester ends and the federal government resumes its spending. One of the other things that will affect exposure growth for property casualty is population change. So I've graphed here the Census Bureau's forecast for population growth between 2010 and 2020. It's the only forecast that I could find on a state-by-state basis with any credibility. And it shows that the population is expected to increase in that decade in South Carolina by 8.5%. That's about even with the expected population growth for the U.S. overall, but as you can see, considerably lower than many of your neighboring states. So decent exposure growth, not quite the opportunities maybe that the other states would have, assuming these are accurate forecasts. On the other side, unemployment. South Carolina's unemployment rate in July, which is the latest data we have, we would probably have had August if the government had not been shut down, but any day when they reopen, they'll publish those numbers. They have them. But July's the latest we have. The U.S. unemployment rate that month was 7.4%, so South Carolina was a little above that, but a little bit better than many of your neighboring states. Not quite as good as Florida, West Virginia, and Virginia, but better than most of the other states. Okay. Forces affecting personal lines. Let's talk about home ownership, first of all. The blue line is the U.S. number. This is the percentage of people who are living in homes they own. The red line is the same percentage, but for the South. Now, this is the Census Bureau's definition of the South, and so it's a fairly broad list. I've got the states listed in the footnote to the chart. 2 points again. Number one, in both cases, these are quarterly data starting in 2007. In both cases, the U.S. and the South region, the home ownership percentage is decreasing. Obviously, the case. More than that, though, the percentage in the southern region is decreasing faster. So the gap between the two is actually narrowing. What this means is that your homeowners, the percentage of people who would be inclined to buy homeowners insurance versus renters insurance will be changing to the negative. Not sharply, but this is a trend that's been going on more generally since 2005. And given the fact that many people who would want to buy houses can't do so, they've lost in foreclosures and short sales and things of that sort, they don't have the down payment or the credit record to buy a new home, the increasing percentage of renters, I think, is likely to continue. And that will affect the purchase of homeowners insurance. In terms of housing starts, the housing market, the orange line here is the U.S. overall. The blue line, again, the Census Bureau's definition of the southern region. They tend to go pretty much together. Obviously, in the case of, these are monthly data. In the case of April, there was a bit of an unusual plunge in the South, but fundamentally, we're talking about a pickup in the South is roughly the same pattern as the pickup in the country, and things are getting better. Moving from the homeowners market to the personal auto market, before the recession in the country, we used to sell 16, 17 million new cars and trucks a year. In 2009, in the recession, it plunged to 10.5 million, so about a third of the new car market disappeared. But this year, the forecast is about 15.5 million new cars and trucks. Next year, if things are on forecast, will be 16 or a little more than that million. And that's about where we were before the Great Recession started. So, if you will, back to normal in the new car and truck area. Really more important in some ways than the number is the fact that we're finally starting to replace the cars and trucks that would have been replaced in 2009, 10, 11. People held on to those cars if they needed them, probably dropping comp and collision because we're talking 10, 11, 12-year-old cars in many cases. So now you have new cars, and now you have higher value to insure. So this should help to pump up private passenger auto premium volume. But, economists always have a but, right? Here's the but. The Department of Transportation measures mileage driven. It's a survey. It's not an exact number. They're not literally counting, what's on your odometer. But they publish the results every month, and what I have graphed here is the rolling 12-month total. So every data point is a year's worth of mileage. And you can see going back to 1990 that even through the recessions, the number basically kept going up. We were driving more miles every month. In the recessions, it slowed down somewhat, but fundamentally kept on growing until November 2007. We hit a peak. The recession drove the mileage down. Okay, understandable, really great recession. A lot of people lost their jobs. But it hasn't returned to the upward path since. This is now 5 years and counting that we've been in a below the prior peak condition. And why I care about this is that to the degree that we are now measuring the exposure base for auto insurance using telematic devices that accurately measure the miles driven, if this is going to be where premiums basically come from, there's not going to be a lot of premium increases because people are not driving as much as if this is an accurate survey of automobile use. So it's hard to tell exactly where private passenger auto premium will go given the two different trends that I just described. I did check because what I showed you before is a national number. This is the number in South Carolina. I was only able to go back to 2010, but obviously the pattern in South Carolina in the last 3 years, 2.5 years, is no different from what it is for the nation as a whole. We're not seeing a lot of total mileage driven increasing in South Carolina. So much for personal lines. Let's look at commercial lines just for a bit. Payroll, which is a measure basically used obviously for workers' compensation, but is an indicator of commercial activity overall. You can see the shaded area is the Great Recession, December 2007 through June 2009. Payroll dropped dramatically, especially into 2009, and then resumed as the recovery began. It actually now is higher than it has been at any prior time. Part of the reason is because this is nominal payroll. It's not inflation adjusted. And we've been giving people nationally raises of about 2% a year on average, according to the national numbers, more or less roughly keeping them up with inflation, not much getting ahead of inflation. So real wages, inflation-adjusted wages, have been basically flat. But nominal wages, again, the workers' comp payroll base, been going up, and we're now at a new peak at a little over $7 trillion. So that's a sign the economy is slowly recovering. Commercial and industrial loans, this is data from FDIC-insured banks. It's not all banks. It's not all lending to commercial and industrial clients, but the pattern, this is, I used FDIC data because it's easily available. This is kind of a failing of economists. You take the data that you can easily get your hands on. I hope it's representative of everything else, but this is what I have. So this is quarterly data going back to 2006. As you can see that The economy was doing nicely, greater lending to this sector. Then the recession hit. That knocked lending down. I'll give you a little insight into that in a second. 2010, the second quarter was our low point here, second and third quarters. And then lending has resumed to this sector to the point that the last quarter we have data for, which is the second quarter of 2013, we're at a new peak in terms of dollar lending to this sector. Now, why are the banks willing to lend to these guys? Here's the reason. This is from the same report, the percentage of non-current loans. Non-current loans are loans that are 90 days or more in arrears. So back in the old days when we were having a very happy, prosperous economy, the percentage of non-current loans was about 2/3 of 1%. Pretty low, and banks had some confidence when they lent money they were going to get it back. As you see, when the recession hit, that percentage increased. In fact, the peak was the first quarter after the official end of the recession at over 3.5% of loans in a non-current status. Slowly, as the economy has recovered, that percentage has improved. In the last quarter we've data for, the second quarter of this year, down to a little over 0.7 of 1%, so pretty much back to normal. Banks are saying, you know what, if we lend money to these people, we might actually get it back. So maybe that's a safe thing to do. And the increase results, as I showed you in the earlier graph, in the largest total of total lending, outstanding debt to this sector that we've ever had. Bankruptcy filings, I've colored the quarters in recessions in orange so they stand out. Kind of a strange thing happened in 2006 because you see the spike and then the plummet, really, in the number of business bankruptcy filings. The reason was because we changed the bankruptcy law and made it a lot harder to file for bankruptcy. And so what happened was people knowing this and knowing the deadline was January 1, 2006, said, well, if I'm going to file now in 2005. That's why the spike in the fourth quarter 2005 and the plunge in the first quarter 2006. It began resuming a so-called normal pattern shortly after that, given that it was more difficult to file for bankruptcy. You see what the Great Recession did, spiked the number to the highest number we've had in many years. And then in the quarters after the recession ended, the gradual improvement in that. Now, obviously, this is of concern because when a business files for bankruptcy, all the commercial insurance they have disappears. This is not a good thing for our industry, but the situation is improving. Now, the other thing to take note of in this chart, maybe a little difficult to see, is that the last data that I have, quarter that I have data for, is the third quarter of 2012. It takes a long time to get these data published. This is actually not government data. We can't blame it on the shutdown. This is from the American Bankruptcy Institute. But the last data they've published is now almost a year old. So I assume that when the data for the more recent quarters are published, it will continue down and will show improvement, but we don't have the data to confirm that. On the other side, business starts. Again, the quarters in recession are in orange, so they stand out more easily. Naturally, as the recession hit, business starts were diminished. Again, the impact on the property casualty industry, start a business, you need to protect what you're starting. People buy insurance as the business expands. There's another opportunity for expanded insurance coverage. And so business starts are picking up a little bit from the low point followed by the end of the Great Recession, not picking up quite as much as I had hoped. So it's kind of a flattening off at a little under 200,000 starts per quarter. The latest data we have here is also at least a year old. The Bureau of Labor Statistics, which compiles these data, says we're not going to count you as a starting business until you have actually been in operation for 9 months, because it is too much starting and leaving within the first 9 months, they say. So we're looking at businesses that are reasonably well established in the starts category, but it's still lower than what we would like to see in healthier quarters in the other earlier blue columns. But the economy is picking up, and we can guess that when we get to see the data for the more recent quarters that are already finished, that those columns would be higher. Okay, other things that affect property casualty insurance in South Carolina: severe weather. This data comes from the National Oceanographic and Atmospheric Administration, i.e. another government agency that is currently shut down. These are data through the end of August for this year. I don't know if you probably can't see the details, but there are three colored dots, three different colors of dots on this map. There's some red dots, there are 8 of them actually, that represent 8 tornadoes that touched down in South Carolina in the first 8 months of 2013. There are 43 green dots. Those are instances of large hail reports. And there are 351 blue dots. Those are cases where high winds were reported. So a total of 402 severe weather events in the first 8 months of 2013. As far as I know, this is a little bit worse than previous first 8 months of the year, but more or less in line with the bad weather you get more or less every year. So when people want to know, not just on the coast, but elsewhere in the state, why are my property rates going up, these are some of the explanations that one can give them. In terms of how bad could it get, we tend to think of Hurricane Katrina as the most expensive hurricane the country's ever had. But this chart now is from some research that Karen Clark and company has done. Karen Clark personally was the lady who invented the catastrophe modeling industry. And what she decided to do last year was to say, well, look, we know Katrina was bad, but we also know there were some really bad storms earlier in the century that when they hit, they really didn't hit much because there was nothing much there. For example, we know that the hurricane that hit Miami in 1926 was a very, very big destructive storm, but there wasn't much to knock down in Miami in 1926. So Karen Clark said, what if we take the meteorological data we have from that storm and apply it to the property and the businesses and the people currently in Miami now? And so that storm, let's say, hypothetically comes back today, what kind of damage would it done? Her estimate, $125 billion in damage. The famous Galveston hurricane, 1900, killed 8,000 people. They wrote folk songs about the devastation that this storm did. $50 billion if that one came back today. Katrina, well, okay, Katrina, she's saying would be $40 billion because New Orleans actually hasn't been fully rebuilt. It actually caused, in today's dollars, when it hit, $50 billion of damage. But the point, I think, and Sandy, the non-hurricane that hit the Northeast last year, she's saying, she rounded all these numbers to the nearest 5 billion. So, but Sandy cost, we know, $19 billion of damage. So things in perspective, was Katrina the worst hurricane we've ever seen? Maybe the one we've ever seen, but not the one we've ever had. The ones we have records for suggest the 1926 Miami hurricane was the worst, and that's only the ones we have records for. We don't know what happened, hundreds of years before. So we shouldn't be complacent that we understand what Katrina was and how bad it could get. Obviously for South Carolina, the reference point is Hugo, and there's nothing to say that we couldn't have another Hugo or another worse one sometime in the future. There's not a prediction of when, it's a prediction of how much, basically, that we're looking at. In terms of actual impacts, this is a chart from research done by the Insurance Research Council. It looked at homeowners' claims in detail from 1997 through 2011, claim by claim, separated out the claims that were catastrophe-driven from those that were not, and calculated both frequency and severity for those claims. This chart shows you the frequency of the cat and non-cat claims coming down. The blue line is non-cat frequency. The orange line is catastrophe-related frequency. And you can see the non-cat frequency came down for a while and then kind of leveled off. The catastrophe frequency is a little harder to see a trend, although if you look at the beginning and end points, we see roughly a doubling of the frequency of those catastrophe claims. So a little bit of evidence then that what we're looking at is a much more heavily catastrophe-influenced property circumstance. On the severity side, both the cat and non-cat severities are strongly up. The cat, that's the orange one, is a little more volatile. I don't know exactly why the severity would function that way. Probably because the number of cat claims is fairly variable, as you saw, and so that might give you a different sample size for the severity. But fundamentally, I think the trend is clear. We're looking at more costly, both cat and non-cat homeowners claims. Again, you want to answer questions about why rates are going up, that's simple reason why. Quick overview on the finances of the property casualty industry nationwide. This is net income, that is to say profit in dollars. We had two very profitable years, 2006 and 2007. The industry pulled in over $60 billion of profits in those years. As you see, we've never had a profit that big before or since. We actually had one year in which the industry as a whole lost money in 2001. 2008 was close to another one like that, only $3 billion in profit for the whole industry. The yellow bar is the first half of 2013. 26 or so, $24 billion, 24 and a half. That's a good number. If you double that, it's a pretty good number for the full year. But then last year at this time, we were saying, gee, this is a pretty good non-cat year, and then Sandy hit 2 weeks later. So we don't know what's going to happen, obviously, in the next 10 weeks. One can hope and pray that it's a catastrophe-free 10 weeks, but you never know. If it is a cat-free 10 weeks, this will be one of the better profit years in the last 5. But as you see, that's kind of a low bar low hurdle to overcome. In terms of profitability measured by return on equity, this is the way most businesses measure their profitability. It obviously gives you a sense of the equity at stake. And this is for the industry going back year by year to the year 1975. This is about as strong a proof I have is that we're in a very cyclical industry. We hit profit peaks every 10 years, it looks like, and then the profits go down again in between. So, a couple of good notes. Number one, we can forecast with some confidence, right? If history holds, the next profit peak is in 2016, just 2.5, 3 years away. So just, note that in your calendars. That's our profit peak. We may have hit the profit trough in 2012 or perhaps even 2009, but I'm sorry, that's 2008. But as you can see in some of these internal numbers, it's not easy to predict when something starts up that it's going to keeping going up. So, highly cyclical industry. If we're doing well one year, that doesn't mean we're going to keep doing well in subsequent years at all. Speaking of underwriting profit, and that was total profit, this is underwriting profit in South Carolina versus the U.S. The U.S. is in the orange bar, South Carolina is in the blue bar, so you can see them. And I did this line by line. The underwriting profit in private passenger auto in South Carolina, that's the extreme left-hand package of bars. South Carolina not positive and actually slightly negative. The U.S. A little less negative, but in most other cases, South Carolina did better than the underwriting profit for other lines versus the U.S. overall. If you go to the far right of the chart, there are 3 categories, inland marine, fire, and allied lines, and in all 3 cases, the underwriting profit for South Carolina was strongly up. In 2 of those 3, the U.S. is weakly up, and one of them in allied lines, it's actually down. So on property, and then commercial multiple peril, kind of in the middle of the graph. You can't really see or barely see the South Carolina number. It's a slightly up. It's like a 1% up on that chart, and the U.S. is down. So looking at property in general, it looks like underwriting profit in South Carolina was better than the country overall. On the liability lines, also a little better, but obviously in product liability, huge losses both in the state and in the country overall. Last chart I want to give you is policyholder surplus. Back in 2007, when, as I said, we had some very profitable years, the Industry surplus in the third quarter reached $522 billion. Many critics, some critics of the industry would say we had more money than we needed in surplus. There was no reason to have that. We should return it to policyholders and give them a break. We kept saying, well, we need this because we don't know what kinds of catastrophes will strike, what kinds of other problems will occur. We were not in the business of forecasting a meltdown of the capital markets, although that did occur. And so surplus actually, mostly for that reason, went down from $522 billion to $437 billion, $85 billion loss. But that did not affect the industry's ability to pay its claims. We still had lots of money available to do that. Every legitimate claim was paid. Nobody's insurance was disrupted. And in fact, since that low point, the policyholder surplus has been rebuilt. The last data we have, last quarter we have data for is the second quarter of 2013, $614 billion for the industry. We are now stronger as an industry than we have ever been. No one should ever worry that if they have a claim that is a legitimate claim, not talking about fraudulent stuff, that it can't be paid. We have the money to do that. If we have 2 Katrinas, 3 Katrinas, we have the ability to pay those kinds of claims. It's, I think, a very underreported story, but I think an important one because confidence in our ability to meet our promises is basically what the industry is all about. So that's the, oh, I have one more thing. That's the economic presentation. Now comes the advertisement. The III has been busy doing some things that we think might help you, and what we've done is create some apps for smartphones. Over on the left, you see the so-called toolkit. There are 3 apps all bundled together, so all you have to do if you want is to download the toolkit, and all 3 apps come at the same time. It's not 3 separate operations. The 3 apps, the one at the bottom of the list here is called Know Your Stuff. It's software we've had for a long time, and it basically helps people to create a personal inventory of what's their property. So when the time comes to file a claim, they can do that in a fashion that's much more organized, and all the data that they need, you know, the original purchase price, a photograph of what the unimpaired property looks like, all that sort of stuff is all there on your smartphone, which hopefully is unimpaired by whatever the catastrophe was that destroyed the property. So Know Your Stuff is a really useful app. The Know Your Coverage is the one that we've recently introduced. It's an attempt to help people understand what homeowners insurance generally does, and more importantly, what it doesn't do, i.e. doesn't cover flood, doesn't cover earthquake. Hopefully people will get that message if they download that app and actually pay attention to it. And the third one is Know Your Plan, which is something we've developed with a number of disaster planning agencies to help people figure out escape routes, various kinds of other strategies for trying to minimize damage when a catastrophe is imminent or after it's occurred. So these are all available for you, and if you find them useful, they're free, they don't cost anything, and we think they might actually help some people. We also are developing some videos. This is a new series we're going to be doing, and the first one is on YouTube now. They're all going to ultimately be on YouTube. It's a kind of a cartoony sort of thing about what homeowners insurance covers. We think it's pretty cute, and also we think somewhat helpful if people actually watch it. And so the early indications are that it's pretty well received. So you might point some of your clients in that direction if you look at it and think that it might be helpful. Again, no charge for any of this stuff. It's our job to try to improve the ability of the world to understand what insurance is and how it works. And this is part of our series. So that's the presentation. Frank, I think if we have some time for questions, and if there are any questions, I would be happy to try to answer them. As I thought, this early does that. Okay. Okay. Thanks very much.